All right, so your question is basically about how to manage earnings trades in the morning after you've put on the trade. And what it sounds like is the question is really around, do I wait for the implied vol to come down? Right? I noticed that right in the morning, the market opens, the stock jumps, but the implied vol hasn't necessarily come down by the amount that we see in the terminal or the amount that should happen after the event is left. And I'm trying to figure out, should I be waiting for that implied vol to come down, or should I be closing out right away? So I think there's a couple scenarios here that we need to run through, right? And what it really comes down to is what exposures we have in the morning. So let's just go through this, right? ABC stock has an earnings event. Okay, now just random company. We sell a straddle, or so let's just say the implied move equals 10% and average move equals 6%, right? Sure, just for the sake of our analysis. So we sell a straddle, and now we have a couple scenarios, right? In the morning, a couple different scenarios could happen. Scenario one, stock opens, or we'll just say realized move is 6%. Okay. Scenario two, realized move is 12%. Okay. Scenario three, realized move is 25%. Okay. Let's say these are like the three potential scenarios that could happen.
Yep.
So we need to think about our trade and really like what our exposures are. So we're going to draw out the analyze trade tab here quickly, for like just following like what you'd seen like Thinkorswim. So actually we'll do this up here. So you sold a straddle, right? And let's say this is what it looks like. Right. And because it's earnings, we assume that we're going to be selling at the money here, which means the stock price right now is here. So the reason, and so our instantaneous P&L maybe looks something like this right now, right? Before the open.
Yep.
So here's the thing. When we have this trade on, what exposures do we have right away? We are delta neutral, right? So we don't have an impact on direction. We have positive theta, we have negative gamma, and we have negative vega, right? So we make money if implied vol comes down. We make money as time passes. We lose money on big moves, and our delta can change as time moves forward, right? So then this is our trade. And what we want to look at is, so of these right now, which ones are we most sensitive to? It's the bottom three. We have a lot of exposure to these bottom three right now. So let's say let's assign a color to each scenario. So we'll say scenario one is we'll say scenario one is orange. We'll say scenario two is pink. And then we'll say scenario three is green. Okay. And we'll just, for the sake of the analysis, we'll assume it's all up moves, just so that we can draw on this graph with ease. So scenario one is orange. We get a 6% move. So the stock moves from this blue line here to maybe like right here. Okay. So in this scenario here, our exposures have now changed. And we still have, so now, we make more money if the stock goes down a little bit. So this is now negative. We still have our positive theta, and we still have a lot of positive theta. We still have our negative gamma. We still have a lot of negative gamma. And our vega will be a little bit lower. It's higher here at the money right now. But as we move further away, we're becoming less from where our strikes are. It starts to be a little bit less. So there's a small change in this. I'm just going to put SC for small change. Okay. But we still have a lot of that negative gamma. So in this situation, what we want is, if we know that like vol could go down like 20 more points, this is significant enough that we should be waiting. Okay. we should be waiting for that gamma or for that Vega P&L. Stock's moved. It's still inside of our bounds. If we can hold out for another 10 minutes, our P&L will increase another little bit. It'll be pretty good. Right? So in scenario 1, we want to wait for the vol to come down to non-event levels. Gotcha. Scenario 2, where the realized move is 12%. Right now, the realized move is out here. I use pink, right? Yeah. So now we're out here. So in this scenario, we have more negative delta, right? We still have the theta and gamma exposure. And for this, we now have like a medium change. But it's still enough where it's worth waiting. It'll still be enough where it's worth waiting. And what you actually want to do is you actually want to look at it. So when you open your brokerage, look at your Vega exposure. If you basically have no Vega left, close it out. But if you still have some Vega, meaning like as implied vol comes down, your P&L is actually going to change significantly. Then it can still be worth holding. This middle one is going to be the trickiest one to figure out because you'll actually have to just be like, okay, I think vol is going to come down another 20 points. How much money per straddle am I leaving on the table here if I close out now? Right?
Yep.
And then the third scenario is where it moves 25%. So this is kind of like the other extreme. So when it moves 25%, we're like now way out here. So in this scenario here, we have like super negative deltas now. We're only making money if this thing comes back in.
Yep.
Right. We still have some theta and gamma, but at this point, it's really not much. Like we're in the sense of like, we're not making any money here unless this thing moves back. Like there's just, it's not going to impact. Like that's not where the money is anymore.
Yeah.
And then when it comes to our Vega, we basically have like zero Vega. Meaning when we're all the way out here, right? Remember, like that means like we're down here somewhere, right? We're taking this huge loss right now. If vol comes down 20 points, we see basically no change in our P&L.
Right.
So waiting for the implied vol to come down is not going to benefit us. But what does happen while we're waiting for the implied vol to come down is the stock is still moving. So what would hurt us the most is if we're waiting for this Vega to come down or this implied vol to come down and the thing keeps running. On the flip side, we're waiting for the Vega to come down and the stock comes back in, we're going to be reducing our loss at the very least.
Yep.
But what we need to remember is this. When we put on this trade, we had no view on delta.
Right.
We are not thinking about delta in this trade. We don't want delta. So, but we've now put ourselves in a spot where by waiting, we're trading delta.
Yep.
It's driving our P&L. And we didn't even want to be in this position in the first place. So whether it works out for us or not is kind of out of our hands. And that's not in the realm of our strategy. So when we see this huge move, when the stock gaps big, we don't even wait. Just get out.
Yep.
Right? Start looking for the next trade. When it moves really small, you'll get a lot of P&L from that change in implied vol. When it has like a medium-sized move, something around the implied move, even if it's a losing trade, it can still be worth waiting for the implied vol to come down.
Gotcha. Awesome.